Let's start with a number. $920 million. That's the official fine America's biggest bank, JPMorgan Chase, agreed to pay for a massive multi-year fraud. Now that sounds like a huge number, right? Like justice was served. But as you're about to see, in the world of high finance, context, well, it's everything. So let's look at another number, $10 billion. And that's a conservative estimate of the illegal profits the bank raked in from that fraud. All of a sudden, that nearly billion-dollar fine doesn't look like a punishment anymore. It looks more like, a licensing fee, a one-time payment for the right to rig the market. This is the story of that fee.
Here at Bullion Signal, our entire mission is helping you find the signal in the noise of global finance. And what you're about to hear isn't some wild theory, it's a documented case straight from the Department of Justice. So if you want to understand the hidden mechanics of our financial system, you're going to want to follow along with this one.
Okay, so let's get into it. For this first part of our investigation, we're going to break it down into three main sections. First, we'll cover the macro landscape, why this all matters on a global scale. Then, we'll look at the crime itself, the documented facts. And finally, we'll explore the shadow motives, the deeper reasons this was even allowed to happen.
So first, we really have to set the stage. To get why someone would even want to manipulate the price of gold and silver, you have to understand what these metals actually represent in our financial system. They aren't just shiny rocks. They're more like a barometer for the entire economy.
Yeah, you can almost think of gold and silver as the anti-dollar. Their price is like a global report card on the health of the US dollar. So when you see gold and silver prices soaring, it's basically a vote of no confidence in currencies like the dollar that aren't backed by anything physical. And that poses a direct threat to the dollar's global dominance, which is a huge pillar of economic power.
All right, let's get to the crime itself. And I want to be really clear here. This is not speculation. This is all based on the Department of Justice's own documents, which laid out an 8-year-long scheme to defraud the markets and, pretty much every single person participating in them. And look, this wasn't a one-off mistake or some rogue trader having a bad day. From 2012 all the way to 2020, JPMorgan engaged in tens of thousands of unlawful trades. For 8 full years, they systematically rigged the precious metals markets until the DOJ finally stepped in. The sheer duration of this it's staggering.
And let's be crystal clear about the language used here. The FBI did not mince words. The assistant director stated, right out loud, that JPMorgan and its employees plotted to unlawfully manipulate markets and defraud traders. Plotted. Defraud. That's the language of an intentional criminal conspiracy.
So here's the crucial point. When you put the fine right next to the estimated profits, you get what we call asymmetric justice. Think about it. If you can make $10 billion by breaking the law and you only have to pay back less than $1 billion, that fine isn't a deterrent. It's just a cost of doing business, a tax on illegal activity. The rational choice, then, is to just keep doing it.
So how'd they do it? Well, the technique is called spoofing. Let me walk you through it. Say you want to buy a bunch of silver, but the price is going up. So you place a colossal, totally fake sell order just above the market price. All the trading algorithms and humans see this giant wall of supply, and they panic, right? They start selling, driving the price down. And the second the price hits your target, poof, you instantly cancel your fake order and scoop up the real asset at the discount you just created. It's a digital sleight of hand.
And this just perfectly illustrates the core problem. What spoofing creates is a rigged casino. A market is supposed to discover price through real supply and demand. But when one player is flooding the system with fake orders, they have total information asymmetry. They know which orders are real and which are just holograms. It's like they can see everyone else's cards while keeping theirs hidden. They completely control the game.
This explains those totally bizarre flash crashes we sometimes see, where an asset's price just plummets on absolutely no news. It was probably a harvest. It makes me wonder,
Have you ever been watching a market move in a way that just made no sense based on the fundamentals? Let me know about your experience in the comments. I guarantee you are not alone in feeling.
So, all of this leads us to the next logical question, right? If they were caught red-handed in a multi-year fraud that distorted markets for everyone, why on earth was the punishment so light? Why is JPMorgan still the biggest player in the game today? This is where we have to move beyond simple greed and into some much darker, more complex territory. The official answer lies in this little legal tool called the Deferred Prosecution Agreement, or DPA. And it's basically what it sounds like, a probation deal for corporations. The bank pays a fine, admits to the facts of the crime, and in return, the government agrees not to press any criminal charges that could actually put the company out of business. And the rationale behind using a DPA is that now famous concept of too big to jail. The fear among regulators is that a full-blown criminal indictment of a bank like JPMorgan could trigger another 2008-style collapse, destabilize the entire global financial system. So they opt for a fine instead, and they allow the very machine that committed the crime to just keep on running. But there is another theory, a deeper motive. Remember how we said rising gold and silver prices are a threat to the dollar? Well, what if suppressing those prices isn't just a crime for profit, but an unofficial service for the state? What if these big banks are acting as proxies, keeping the market's fear gauge broken on purpose to protect confidence in government-backed money? There's this quote from an analysis on the topic that really just sums it all up perfectly. If you see the bank not as a criminal, but as a soldier carrying out policy, the light punishment starts to make a kind of cynical sense. You don't put your own soldier in jail for following orders. You just fine them for getting sloppy and getting caught. And this brings us to what has to be the ultimate conflict of interest, one that still exists today. See, JPMorgan isn't just the biggest trader rigging the paper price of silver. They are also the custodian for the world's largest physical silver ETF. The same group that's manipulating the price is also guarding the physical asset. It is, literally, the fox guarding the henhouse. By understanding these kinds of conflicts, you're joining thousands of other strategic thinkers in our growing community who are all learning to see behind the curtain of the financial world. And it's not about being cynical. It's about being realistic, about understanding how the game is actually played. Now this is where the story takes a really dramatic turn. See, everything we've talked about so far, that was manipulation driven by pure greed. It was about hitting bonus targets, plain and simple. But the game has fundamentally changed. The manipulation we're seeing today, it's no longer a weapon of offense. It has become a shield of defense. It's not for profit anymore. It's for survival. So the critical question we have to ask now is this. They built this incredibly sophisticated trap to extract wealth from the market. But in doing so, have they now trapped themselves in a position they can't get out of? And maybe more importantly for all of us, what happens when that trap finally breaks? In part 2 of this investigation, we're going to explore that exact question. We're going to dive into some heavy concepts like the naked short squeeze, the doom loop created by demands for physical delivery, and the ultimate escape hatch for the banks, the force majeure clause. We will break down exactly what all of this means for the market. The pressure in this system is building, and the end game is getting closer. The whole structure that was built on a glitch is now starting to show serious cracks. To make sure you understand what's coming next, subscribe now and turn on your notifications. You are not going to want to miss part 2. And as always, please remember, this is for informational purposes only. It is not financial advice. All of our analysis is based on publicly available documents, including the DOJ report itself. Our goal isn't to tell you what to do, but to give you the knowledge to see the financial world for what it truly is,